All right, welcome to our Franchise Accelerator podcast episode. I would say one of our most important, because we are going to talk about year end. We are down to the wire. 24 hours, 48 hours, like we are there.
Depending when you're watching, it's about over.
The ball is about to drop, but it hasn't dropped yet.
Correct.
So what we wanted to go through today is a few last minute things. I think also getting in mind that yes, we are at year end, but not everything has to be done before the clock strikes midnight, right? There's a lot on the financial side that we can still gather after year end, but just having that awareness of, wow, like I'm closing the books on 2023 very soon. So the first thing that we were talking about a little bit as we were getting ready is the idea of inventory. I think what we want to do from a standpoint of accounting and, financial statements is really understand where we are. And the most important part of year end really is not your P&L, although that's part of it. It's really your balance sheet. So just a quick reminder, for those of you who may forget the rules on the balance sheet, but the balance sheet is as a point in time. So it's as of one day, which would be 12/31/2023. So everything that we're going to do with our balance sheet is focused on where we are on that day. So it's not about going back and cleaning up a year's worth of transactions that we know are wrong. When we're looking at our balance sheet, we really are looking at where is that number today. So where's our cash today? Where is our receivable balance today? And where is our inventory balance today? But when we talk about inventory, especially in hospitality and retail, we want that to be something that has future value. So if you remember, inventory it's an asset, which means it inherently has future value. So we don't want to carry with us things that are outdated, they're old, I'm not going to use them. Those would be what we consider a write-off. So when we go and we look at our balance sheet, inventory, I think, is one of the most important numbers because we don't want to be too high because then we're just, sort of inflating our revenue. We're paying taxes on money that we really don't have. And we're also really now focused on those are dollars that are sitting on my shelf. So if I have a $10,000 inventory, that means I'm going to sell that $10,000 next year. But until I sell it, my cash is tied up in that inventory. So from an ops standpoint, talk to us about some of the things we could do to get ready for an inventory. Maybe I've never taken one before. I've never really thought about it before.
Right, because we would recommend weekly or monthly doing inventory, but that's okay. If you've never taken it, that's fine.
Yes.
This is a great time to start. Right?
In the past, your accountant will be so happy with you, actually.
Right. So the first thing we'll do is organize everything, right? So again, now you're, from an operational standpoint, you're not just looking at dollars, you're getting your restaurant, your retail back to organized. Yeah. Everything, maybe is really busy the last few weeks. Things can be thrown around. Maybe something's blocking something you didn't know you had. So every shelf gets organized, every storage area gets organized, and it's a perfect time as, again, if we're looking at how much dollars we have sitting there, we don't want to order 3 cases of something that we have 2 that was hidden behind something else. So that would be step 1. But step 2 is making sure that each thing is categorized how you want it. Yes. Right? Are we counting each individual item? Are we counting the case? Where was that inventory going? Is it going in a software system that you use for inventory? Is it just going as a dollar number in QuickBooks? Yes. But somewhere it's in there. So like Ann said, you have value, you already paid for it. And then as you go on to, January, the operational side was maybe you could save some money because you already have some of the stuff. That would be the big operational
I think a lot of times when you see people who take an inventory for the first time, they're surprised by its dollar amount. We had a client recently who took an inventory for the first time, and it was probably double what they thought it was going to be. Like, I thought I had $10,000 in inventory. I actually have 20. So from that standpoint, say I have 20, how do I start to kind of bring that down?
Yeah, I think that's just coming up with a plan with your team, whoever does the orders, what that plan over the next 4 to 6 weeks are, right? If there's items that maybe we over-ordered and we weren't as busy as we thought the week between Christmas and New Year's, which could be the busiest week of the year for restaurants. So what if there's a snow day or something, something happens? I would think, what's the plan to get rid of that product, right? Do we do specials? Do we create a new menu item? Do we something that, get rid of the perishables? Yeah. The other stuff that's like dry goods or chemical or paper, let's just figure out now what can we not order over the next month, 2 months, 3 months. Yeah. Who knows how much you have sitting there, and at least keep your cash on hand and use through what you have.
Well, and I think that's a really good point because from an accounting standpoint, this is where your accounting team and your ops team need to work together because from an ops standpoint, you could say there's no way I can count everything. I mean, look at the amount of paper products, look at the uniform shirts I have. Whereas your accountant might say, well, I knew you weren't going to count it, so I already went ahead and expensed it. So we don't need you to count every paper plate that you have because that's already on my P&L. Like I wrote off everything at once. So that would be a good discussion to have because as a GM, you might say, well, I don't want you to write off $5,000 of supplies that I'm going to use over the next 2 months. I'd rather keep it in inventory and give you the inventory balance every month. But if you're not going to keep up with the count, then your accountant bookkeeper is just going to throw it into the P&L. Neither is wrong, but this is a great time of year to have that discussion because I think too many times we blow off inventory, so we don't have time for it. We tell our accountant, maybe next year, forget it. And I cannot tell you how many times I've seen when someone goes to get financing, they're getting an investor and they say, how could you possibly be a restaurant with no inventory?
Right.
It's a really good question.
Yeah, because it's a lot of dollars. It's a lot of dollars. That's going to add to it. No, I think that's a great point to set. Start now, get it in there, get your system. And then we would recommend, whether it's weekly or monthly, because I will say, I mean, we've done work restaurants, do $15 million in sales with 200 plus menu items. And we did inventory every week. It still can be done. It's not, I think one of the things, once you have a system in place, it's not going to take you and your team that long to do it. Well,
and I would say hands down, I think what we've seen is there is a direct correlation between the people that take a weekly inventory and the people that are the most efficient. That as much as your team might complain and you don't want to lose your good people, like you said, it's a non-negotiable in a corporate environment, right? If you turn to your boss and was like, no, sorry, no. Like, it's not going to happen.
Oh, because it leads to so many other different things. That's the thing. It's not just, we're counting it as an exercise just to be busy work. We're trying to figure out, are we ordering the right amounts? Are we wasting anything? Could there be any theft? There's so many things that stem from it that's why we do it, not just as a busy activity to waste time.
No, it's the cornerstone of our decision making and our, financial statements. If we don't have a change in inventory, then our cost of goods is not accurate. Right. And we know that, but if we don't have that part of someone taking account, otherwise we're just guessing. And I think, that's where what's so important from an accounting standpoint that we forget is a lot of, the wording on the accounting side is it isn't just an inventory, it's a physical inventory. And I think a lot of times we get kind of lulled to sleep by software. Oh, the software can just do an adjustment. It can predict the adjustment. But until you're standing there looking at the shelves, talk to us a little bit about that.
Yeah, well, it's not always right, and that's the other part is, right, even if your system is set up perfectly, right, your purchases are in there, your software tells you what you sold every day, so everything should be in there, so in theory, at the end of the week, you should have 10 cases of this.
Right.
If you don't count it, you don't know.
Right.
And I think that's whether it's theft or whether I've seen different things where it's wrong. The system's just not talking correctly. Yes. It's just saying maybe a recipe is not incorrectly. There's so many ways that's not going to be, so you need to validate it. The other thing we see sometimes is when someone does do the inventory, they're just doing to check the box.
Yes.
And that's a waste of time.
Yeah.
If you're not validating that what that person's doing is correct each week, and obviously there's a mistake every once in a while, that happens, but so many times we see that, they're saying they have 20 cases of this and they have 2. Yeah. And they have 100 pounds of this, they have 1.
Right.
Now you're falsifying information and you're getting wrong information to to your books.
Well, and that's why I think it isn't just, taking a look, it actually should be the owner, right? In some regard, and the owner's eyes should be on it, because it would be too easy for someone to just be like, well, there's 8 fillets when there's 2, but if they're putting in the software, you can have a manager involved too, right? So we just need to have, even if it's a spot check, right? Sure. You're going to pick 5 items that you're going to go count. You don't have to do it all day, but just that little reminder that you are going to take a look, you are going to check them. It's so important. So, all right. So our first thing it's not too late for is inventory. The next thing I would say is really looking at your sales, right? Delivery fees, just double check, before the end of the year. And it doesn't have to be a big check, right? I would say 1 week even. Take your point of sale, run the sales report, have your bookkeeper send you that week and just check, because so many times it's not that the bookkeeper's bad, right? We don't want to throw things at the bookkeeper. Right? And it's not that your manager's bad, but there are times where things just get disconnected. It happens. But if we wait until the end of the year, there's the risk that number gets on a tax return, nobody checks. So don't have the assumption that somebody's going to check at some point. I think this is another thing that the owner, just to sanity check yourself. Once you know it matches, then now you know when you get the report at year end from your bookkeeper, you get the report from your managers, you know you're good. So definitely think, and then I think on the third party side, it's understanding how those are set up.
Right. Well, how are they charging you? How are you getting payments? Because that's, I would say, we probably have seen the most maybe over the last couple months with, is just either fees aren't showing up correctly, or even the sales aren't pulling correctly. Again, sometimes the owner doesn't know when they're supposed to get the sales. Is it every day? Is it weekly, monthly? So there's a lot with that, especially because it's just even how they started till now may have changed. That's what we're seeing. You might have signed up for, let's say, DoorDash or Uber Eats 2 years ago, and maybe they were giving you money this way. And at some point along the way, it changed. I don't know why. You don't might not know why. And now we're like, instead we're getting to year end, and you're like, wait, I don't see any fees on my QuickBooks. Well, you paid fees. Right?
Well, right. And a lot of times the manager may have thought it was already, because I think a lot of times the softwares have tried to integrate more. So, you thought the fee was coming out every day or it was showing up as a discount. But we just want to check, because it's not like the manager was wrong. They could have been told it's there and it's just not there. So it happens, right? So we don't want to go back and get angry, but we just want to go back and fix it, because especially like you're saying with the fees, we want to make sure that that's included as an expense.
Right. And we've seen even some of the third parties do it differently. That's the other thing. We've seen like, DoorDash does it this way, Uber Eats does this way, and Grubhub does this way. So maybe Toast is talking to 2 of the 3, but not the last one. So there's been a lot of, we've seen some of the confusion on that if you're not looking at it somewhat regularly. So.
And I think the other thing to really focus in on sales is your catering deposits. Right? We want to make sure that when we go to year end, again, don't assume that your accountant's going to ask you about catering deposits. They might not even know you do catering, right? I'm just saying. I mean, they're in their own little bubble of dealing with the IRS. So, it's okay that you want to check first. And catering deposits is a big one, because we want to make sure that we're not claiming revenue that we haven't earned yet. And I had, a discussion. We did the restaurant owner tax thing this week, and a great question came up, because they said, oh, but I'm cash basis, so I'm just going to pick it up as cash. Well, the catering deposits are different, because you have not earned that money yet. So yes, you have it in hand, and yes, you might be cash basis, but you haven't earned that yet. And I think anyone who remembers COVID, right? How many times did you have catering events the last couple weeks of March that you had to give back because something happened and it was canceled? So to me, cash basis or not, to me, it's revenue when you earn it. And so we want to make sure, ask your team, because this is the other part that's changed on the software side. We have new catering software that nobody seems to understand.
And we said there's a lot, and that's kind of been a lot of new softwares that weren't here a few years ago, because there is a need for them, because they do keep track of the money and the events and all these things. But if you're not aware on how it gets to your balance sheet, how it gets to your P&L correctly, that's where we're seeing the problem. It's not that you don't have the money, just where it's going.
And that's where I think a collaborative approach with your bookkeeper or CPA, because, we had a couple clients where it's like, well, these people paid their bill, right? So what do I do with it? And that's a good discussion, right? Like walk through, well, is there a refund policy? Is this a deposit or is this a sale? Like, what is this? And let's just talk it through rather than just, pointing fingers. Let's work together to say, we want to do it right. We want to make sure we did it right. Okay, yes, this is going to be a sale this year, or no, it's going to be a deposit. I'll pick it up next year, and make sure everybody's on the same page. Everyone knows what it is well before we go and we do a tax return.
Right, exactly.
All right, so I'm going to say your next homework is your sales / deposits, and then kind of working our way down the, balance sheet. The next would be your fixed assets. right? Did you make purchases this year? Was it in service this year? What did you buy this year? You know, as we're looking at last couple of days, let's make sure, right? I mean, if you're not cash basis, so if you're accrual, which again, it goes back to knowing the rules. If you're accrual basis, you don't have to pay for it in order for it to count in 23. It has to be in service. So you could have a bill that you are going to pay next year, but the piece of equipment could be sitting in your location right now. But if your bookkeeper doesn't know that, it's just going to go in 24 when they pay it. So we all need to be on the same page of like what equipment is here. What do I have? Now, if you're cash basis, you have to pay for it.
Right.
So that's where we have to know before year end, because there's a couple of days where we can still write a check and make sure it's in if we have to. Because too many times you see people like rushing to write the check, but you're accrual. So you don't have to pay for it. You just have to have the piece of equipment. So just do that check, you know, keep it on the radar. Also make sure that your accountant is aware of it. We've had plenty of cases where someone used a personal card for points or whatever. Right? We just want to make sure that we get everything documented and, you know, you get reimbursed for that, but it counts as a business expense, because I think it's really important to know that's also some of your cash flow, right? Like if you say, where did my cash go? Well, this is a great time to look and say, oh, look, my fixed assets went up by $90,000. That's where my cash went, and that's okay. But I want to see that.
Yeah. And how that work for the same for like service? Like let's say this week's a big week and you have a huge plumbing problem. They come out and it's a $4,000 bill, right? So that kind of translates. But
I would say I had a call with a client this week doing tax planning, and they were like, "We've asked all of our service providers to invoice us this week for work they've done, and like nobody does."
Well, that's what I mean, right? You can't always get the invoice. I know that I'm serious. You can't always. If Christmas Eve or New Year's Eve, you have something and they have to come out, you don't always get an invoice for that.
Well, they don't want to because it's income to them.
Correct.
So, yes, it becomes a little bit of a hot potato. But the rules for the business is when the service was done.
Right.
So, you want to press them to send the invoice, because you don't even have to pay it. If you're accrual, it's when the service was done.
Okay.
Cash, it's when you pay for it. So be aware, right? Ask your accountant, ask your bookkeeper, what am I? Just so you know, because you don't necessarily have to pay them, but you need that bill.
Right.
So, and it may be hard. They were, I think, like over 3. Yeah. They had 3 people with them invoices. It's like, well, good luck. They may not. Because again, they're picking up the income.
Right.
So it's an important discussion. But once you wait till January 15th, you know, it may be too late for them to generate the invoice and put it in the prior year.
Right.
Yeah. So, all right. So keep that in mind on our fixed assets. The next is going to be our accounts payable. So if we think about the bills we owe, this is also similar to fixed assets, but also all of our bills, right? So what we want to do is kind of look at our accounts payable, make sure it includes everything you know is sitting on your desk. Again, if your bookkeeper is a couple weeks behind, that's okay, but year end is really important. We want to make sure that all the invoices get in with the correct date, and they're, you know, your list of what you owe at the end of the year is accurate. Because too many times, again, when your banker is looking at your balance sheet, more than the P&L, as much as we think they're looking at the P&L, they're really looking at the balance sheet. And we want to make sure that number for your outstanding liabilities, your payables, is right. So if there's stuff, if there's credits, if there's, oh, I paid this, just didn't get it recorded correctly, we really want to make sure that's there, because the other thing this affects is your cost of goods. So if you had, you know, say you got invoiced for something, and then, you know, you made a payment on an ACH or something, and somehow you have it in both places, that's also affecting your cost of goods. So your cost of goods would be showing too high because you have the expense, but you also have the bill. So just a quick look at the bills. Might be a good time to ask your vendors for statements as you get to year end.
This is the time I would always have the bookkeeper or someone in the office call every vendor and say, I need that. Because like you said, if you got it January 3rd, you still can probably get it completed and be year end. So.
But the statement as of year end is great, right? It's a great check on the booker, just in case they didn't miss anything. It's crazy year. It's been a crazy year. So, you know, we don't want to go back and yell, but we just want to do this as a good check.
Clean books going into the next year.
Yes, because that's a great starting point for them, rather than carrying it through and have these lingering things. So, you know, quick look at the AP. That's really important. And then the next one is our loan balances, right? So a lot of times our bookkeeper's just recording the payment, right? They don't know the interest and the principal portion, and that's okay. But at the end of the year, we really want to make sure that they're recording the interest because the interest is a tax deduction where the principal is not. So again, similar to the vendors, call the bank, say, hey, can you give me my most recent statement? I think a lot of times now it's hard because everything's online, so it's harder to get the statement, but it doesn't have to be done right before year end, but it's definitely something to be aware of that, you want that 12/31 statement just to make sure the interest is correct. So then the other part is just going to be money that you put in. So did you put any money into the business this year? Tracking that, making sure that we have our investment is captured. And this would be true for you and any investors. I think that's the other thing that I see come up a lot at year end is, your investor might say, well, I put $10,000 in the business. Are you tracking it? And in truth, you may not be, right? You were busy. You just went to the bank balance.
Just took the money and threw it in.
You made payroll, you're good. But, now that we get to year end, they will be happy if they know that you've tracked it, you've recorded it before they ask, because that also plays a part into the tax return. So you want to make sure that, yes, I have a schedule, I'm documenting it, and, it isn't lost, because I think that gets lost pretty easily. So then, operationally, is there anything else you do? You have 2 days left back in your operation.
I was talking about the last payroll.
Yeah.
Like bonuses or owner salary. What could, is that the decision now? Is that decision already passed us?
Well, no, that's true. I think, the big thing there is owner salary.
Okay.
And also knowing if you're accrual or cash, because if you're accrual, you can always run it in January and book it as a prior year. But if you're cash basis, but yes, definitely, I think we get a lot of the questions this year about bonusing employees.
Right.
Can I bonus them? What does that do? And I think for me, a good strategy here that I talk a lot about with our clients is the idea of reimbursements. Okay. Especially if you look at your manager team, are they using their cell phone every day? Are they kind of using a home office? There's stuff that you don't really think about throughout the year, but that they incur that you're really not compensating them for. That's a great thing to call a bonus. So rather than giving them, $500 on a paycheck, you could call it a reimbursement for the use of their cell phone for the whole year, and then now it's tax-free to them.
Right. Nice. And is there a benefit or for the business there, or is it pretty much...
It's a benefit on the business side, too, because you still get that deduction. Now that's just part of your telephone expense, right? But you don't pay the payroll
tax on it.
Yes. So again, nothing we want to go crazy.
Right, but it makes sense.
But, and I think a lot of times, especially with the manager, kind of writing it in as this is a discretionary, this was based on the use in 23. But long term, especially as we get into more expensive management teams, it's something that as a company, that could be your policy. That if you're GM, you get $500 towards cell phone. You could come up with what those are and do this monthly. It doesn't have to be done at the end of the year. But I think something in writing, I always like to say something based on that position. So that way, like, the chef can't come back and say, well, I get cell phone. Well, when you're GM, you get this. When you're chef, you get this. And that way, it's fair across the board. But, there's definitely things, I think also for owners, thinking about, do you have a home office that you should be reimbursed for? Again, we want to keep it reasonable, but your company policy could also be to reimburse the owner for home office, owner for cell phone. So those little things, as much as it seems like it's not going to move the needle, it's all about, incremental tax savings. And if you're in a 20% effective rate, that's going to save you 20%.
Right. Just could be a big difference. It could be a change, or it gives you from profitable or not. There's so many different ways it could go, or variables once you get into it. So. Yeah,
but that's again like being aware, and I think that's the other part of from an ops side. Once you know, okay, am I profitable?
Right.
And you know what my effective tax rates. If you haven't had time to watch our restaurant owner seminar, we go through all of that. Once I know, okay, I'm in the 20% effective rate, and I'm profitable. Okay, maybe I do want to make that extra. Repair guy come out this week. Maybe there are a few little things, but even if I spent $5,000 this week on just stuff I was going to do anyway, the repair, the piece of equipment is just missing, whatever it is, at 20%, That's a good tax
$1,000
yes.
on that five. You basically got it on sale, right?
Right.
You basically paid $4,000 for a $5,000.
Exactly.
If you look at it like that,
exactly.
It might change the decision making on something else. So I say, yeah, it is worth that. So.
And then I think the second piece is, to all of this is knowing, okay, once the book's closed, you do still have some time to put everything together, especially remember the pre-tax retirement accounts, like IRA contract, all of that really doesn't have to be done until April 15th. Okay. So don't panic. There's nothing. The key here is getting the books in order, going through the balance sheet, saying like, yes, these are final numbers. And then we can do some, tax strategy and tax planning from there. So, all right. Well, this was a good episode. Happy New Year to everyone. And we will see you in 2024.